Hello and welcome to a fresh new edition of Taking Stock. This is the show where we review the week which has gone by. It's not been much of a week, not measured by action, but just in terms of the number of trading days. But nevertheless, we will sort of count the main highlights of the week for you. But more importantly, as we always do over the next 30 minutes, prepare you for what may lie next the coming week. I am Prashant Nair. With me, my colleague Surabhi Upadhyay, coming to you from Delhi. Hi, Surabhi.
Hi, Prashant. Well, yes, I think the rain gods have been smiling on Mumbai and on Delhi. So at least I think that's one positive as far as trade is concerned. Well, we've got a packed show as always. We're going to get started and tell you about everything that happened in the week gone by. And of course, the cues that are important to watch out for the one that comes up ahead. As we do that, let's quickly run through some of the highlights. It was, of course, a holiday-shortened week. So we're talking just 3 trading sessions, really. And where do these 3 trading sessions leave us? Well, still fairly precariously poised, a little fragile in sentiment. There's no change from that, no taking away from that. At the end of Friday, the index at that level, at least it's above 11,000, so to speak. But nonetheless, the last 3 sessions have not been very easy, particularly the one on Tuesday, because that was a big gash on the way down. In a sense, the hope trade that we had with the series of meetings that the finance minister was having with FPIs, with market participants, the hope that was built up in the run-up to those meetings, a lot of that was undone on Tuesday. So that was, of course, the one big day, the sell-down day that we had. Some recovery, so the saving graces that both on Wednesday and then again on Friday, we had some recovery. And at least there's a fatigue with respect to the sellers that's setting in. And the bulls will perhaps just have to be content and take heart from that. If I talk about some of the data points from the week gone by, then the picture is still grim. We, of course, concluded the Q1 earnings season, and some of the last bits of numbers that came through, for instance, the auto sector, some of the big ancillary players like Motherson Sumi, Bosch, or even Bharat Forge. I mean, that's really telling you how deep and real the pain is. Most of these companies missed estimates pretty much, across the board. And the commentary was also talking about how things seem to be quite dire, at least for the time being. So what was the silver lining? One, as I said, that there's some fatigue with respect to the selling. 2, perhaps the fact that the market is still holding on to hope. Though we saw that big disappointing trade on Tuesday play out, there's still some expectation that an announcement will come through from Delhi with respect to either taxation or the auto sector. Now, I mean, one really needs to see if that will actually come through or not. But at least that hope seems to be intact. And last but not the least, the point that I made earlier that, at least monsoons have been aplenty and the deficit has been completely wiped out. So those are some of the takeaways. Net, we've got about a 0.5% drop on the index, a little more than that on the Bank Nifty and on the mid-cap index. But for more detailed analysis of the stock-specific action, let's go across to my colleague Sonal Bhutra.
Thanks a lot for that, Surabhi. Well, the week was small, but the moves were not. Let me start with the big Nifty movers. And of course, the big boy Reliance is the first one on my list. Up around 10% after the big announcements in AGM and also a lot of upgrades coming in from the brokerages. This also came after India Bulls Housing Finance. That was up around 11% in this week's trade. Zee Entertainment also up around 5% after Oppenheimer said that they believe in Zee's underlying business and they are confident about their growth. GAIL also saw some good moves coming in this week after good set of numbers that it reported last week. But the list of losers is even stronger. Let me start with Eicher Motors. It was the biggest loser on Nifty this week. Remember, the auto sector also was down around, autos index was also down around 2% this week. Moving on, Wipro and TCS, the 2 big IT giants, down around 3 to 4% this time around. Moving on, let me talk about some other stocks that were losing this time. HDFC, NTPC, Britannia. NTPC because of weak set of numbers, and also Britannia because of volume growth lower than what the street was estimating. Let me talk about the broader markets then. A lot of moves coming in there. The biggest mover, of course, Godfrey Phillips after smoking hot numbers. Vodafone Idea also is up around 20%, and a big move came in today's trade itself. Apollo Hospitals after reporting good set of numbers, up around 8% this week. Moving on, the other stocks like Dr. Lal's, IGL and CESE also saw some buying coming in after good set of numbers that the companies reported. But all is not good in the broader markets as well. Some losers included the likes of Glenmark, Divi's Labs. These 2 pharma stocks did see some decline. That is because of weak set of earnings. Pharma index was the biggest loser this week. In fact, the other losers are the likes of Sobha, Aarti Industries that actually lowered its FY20 guidance, and also we saw losses coming in for IDBI Bank yet again, and that stock also saw some beating in trade this week. Back to you.
Sonal, thank you very much for that. So that's essentially a stock-wise, sector-wise look at what has already happened. Now let's look ahead. And I'll take 90 seconds to say this. And I'm just sort of begin by we told you so kind of a moment. Beginning of this month, to be precise, on the 2nd of August, this is what we had said. We basically were looking at global market setup, and we said, and at that point in time, tensions with China had risen once again in terms of tariffs. There was also the Fed, which was, the Fed action and words which were not perceived to be as dovish as what markets liked. So on the 2nd of August, we basically said that the same phenomenon had appeared earlier in May of 2019, earlier this year. And at that point, in the month of May, we basically saw a 8% fall in the S&P 500. So we said, well, be prepared for a bit of turbulence. We've got the turbulence. From that point on, from the 2nd of August, the S&P 500 is down about 4.5%, nearly 5% or so. It doesn't have to be 8%, but you get the idea. Essentially, markets have been lower. Remember, I'd just like to add, the Nifty in that same period, basically month to date, is down 0.7% or so. So it's not as if, the S&P is corrected 5% and we are sort of selling off the same or more. It's just that there has been no there's been no help from global markets. That was basically the point of what we said back then. I don't think the situation has changed that much dramatically as we stand right now. So what's the big playbook? What are the sort of key big things which are playing out every day nowadays? One is lower yields. Across the yield curve, 30-year, 10-year, 2-year, there is basically yields are breaking down, which essentially means that the yield curve is also inverting. The 2-year, 10-year, for example, is inverted recently for the first time after 2007. Same is true on longer maturity yield curves as well. It's meant lower equity markets. The recent correction, of course, is a case in point, but this has been a long time in the coming. We've been highlighting that. It's also meant higher volatility. We've not seen that per se in wicks, etc. But generally speaking, market volatility has started to pick up, relatively speaking. We've seen lower industrial commodity prices. Oil prices specifically have come off. And safe haven is doing well, be it the safe haven currency pack like the Japanese yen or the Swiss franc, etc., but also gold, which is doing very, very well. That's basically the playbook as things stand right now. Is it going to be any different? I've just looked at two things. One is the VXN, which is the volatility of the Nasdaq, and I've looked at the volatility of the S&P 500, which we call the WIX. Both these are essentially showing double bottom formations. Basically, this is the same pattern we've seen in early 2018 and late 2018. And what happened in these two episodes, which is early 2018 and late 2018, was that volatility after making these double bottom formations picked up aggressively and stock markets sold off aggressively. Will we see it's the same here this time around? As I said, history doesn't repeat, but it does rhyme. And that's the reason why I'm saying that be prepared for more turbulence from global equity markets. The point of all of this is, as I said in the beginning of August as well, the benign global equity environment which we were so used to, and we were kind of blaming that, well, the globe is doing so well and the market here is still sulking. I don't think you can take the former for granted. Global equity market now seemingly a bit more tough in that sense and not benign. There is enough to talk about the local factors and what can propel a rally here. And I think most of all, the big one is going to be government action, which I think is what we'll discuss with our guest who's ready, I believe, on the show. Surabhi.
Right, Prashant. Well, yes, the market has a double whammy of sorts now to contend with, local issues and global ones. Joining in to discuss all of that today is our next guest on the show. We have Ratnesh Kumar, MD and CEO of Bob Caps with us. Ratnesh, thank you so much for joining in on Taking Stock this week. And that's really my first question. Global or local? What's the bigger headache for the market right now?
Well, as far as market concerns, everything matters. At this point in time, it looks like the world is kind of, the world economic picture is softening all the way around, and you have yields coming down. So clearly, I think in that kind of environment, it is again the monetary policy action that the market will look out for in the next few quarters. But as far as we are concerned, I think in addition to the global headwind, so to speak, as we have right now, we do need to have few of our local issues basically looked at in terms of what sort of policy action comes to sort of address the growth worries which have been sort of taking more and more strength in the last few weeks.
So to talk about some of the local issues first, Ratnesh, this whole slowdown bogey that's really become a big reality now. What is priced in the market? I'm just trying to fathom that, because the market is building on this hope that eventually New Delhi is going to deliver. I mean, A, are you expecting very sort of significant action? If so, in what form? And in B, what's the time frame? I mean, what if it doesn't come through in the next week or two?
So, the slowdown, it is, if you look at actually a little longer horizon, last 4 or 5 years, we have in any case been in a investment capex sort of a slowdown. So that recovery has not been coming through, and you basically have had much of the growth led by consumption. And so what's really impacted growth in that side is that the dislocation that we've had in the financing space with the NBFCs in the last 6 to 8 months, that has really impacted consumption, especially the ones which are linked to financing. And so first up, I would think any addressing of that and the sort of energizing the wheels of financing, to my mind that should be the first priority. The measures were announced in the budget. As they get implemented vis-a-vis the NBFC book buyout, etc., hopefully that begins to get the financing engine rolling again. So that is the first and major issue. The other issue which has been bothering the market, I think, on the FPI tax surcharge, market is hopeful that some sort of action comes through from the policy side on that. So that's the second thing to watch out for in terms of the local factors.
Ratnesh, so if the government, we still don't know whether the government is going to act in terms of providing some sort of help, stimulus, etc. But what kind is really required, in your opinion, to sort of put some life back into this market, in your sense?
Well, first and foremost, I think what is required is that the financing engine has to start running again. Because some of the segments like autos and real estate, there was a big contribution from financing by the NBFC sector. So that in some shape or form needs to come back, either via the banks or through any other mechanism. But that does need to come back for the confidence and the liquidity to return. And I think in there the policy measures were already, so to speak, announced in the budget. As that gets implemented, I think that will be real key to watch. In terms of any additional measures, I would not think any stimulus which requires anything from the fiscal side. It is more to do with getting the liquidity going and some confidence building measures, be it on the FPI tax surcharge or anything further than that, in terms of which doesn't impact the fiscal very much. Something like a long-term capital gains tax, it doesn't collect the government much money, but I think at this point in time it is important to realize that one of the big problem in the economy is leverage, and one obvious solution to leverage is equity. Naturally, there can be asset sales, there can be restructuring, there can be a takeout of assets, but all of those are long processes. But one of the ways to address the leverage issue is if the equity becomes more of a viable option, which clearly anything which improves the sentiment on the equity side, it is going to help the broader economy deleverage.
Specifically with regards to sectors like autos, etc., Ratnesh, do you think we'll see some relief, sector-specific relief?
I have no idea on that. I don't think the sector-specific relief would matter that much, simply because the issue there is more macro. I don't think it is to do with a little bit extra, GST or less GST. The issue is more macro in terms of financing.
So,
if
having
it comes,
said
it's
that,
great,
Ratnesh,
but
the
I think
question is. No, I was just adding on to a question here, Ratnesh, that, there's also a debate of whether this is cyclical or structural. Some of the companies like Bosch made a very clear statement that this is not just a cyclical slowdown, there's something structurally wrong here. Which side of the debate would you be on? And then, therefore, would you look at picking the bottom on some of those auto stocks? Because you're getting, bargain basement pricing here.
Well, I think instead of getting into cyclical and structural, you can call it a cyclical slowdown if there was a huge demand boom in the prior years. I think that was not the case. It was a steady growth which was there earlier, and so certainly not cyclical. Now, it would be structural if there was something fundamentally changing in the consumption pattern within the economy or the demographics, etc. No, though all of those still remain favorable. I think what you have is clearly there is the financing engine. Once it gets sorted out, I think some of the cyclical or structural debates will sort of settle down, and we can get to a normal growth kind of situation. And naturally, there has been some amount of slowdown in the economy, so to that extent, one can expect the demand to come down, but it has come down a lot more because of the financing concerns. And so to that extent, I don't believe it's neither cyclical nor structural. It is something which is linked to the financing issues, and because they will take little longer to resolve. Hence, I don't think the bottom is yet in place in terms of the industry fundamentals there. It could take another quarter or two.
Ratnesh, that brings me to the overall question on approaching this market now. Because we are in a situation where we don't know how prolonged the slowdown patch is going to be, and when the rate cuts really start showing up effect, or if there is to be any kind of a policy action, when and if and how and what format, we don't have answers to a lot of these questions. So therefore, what's the best way of approaching this market? If you have 100 rupees on you right now, how much do you deploy? Do you go to tried and tested names like consumer staples? Do you go back to private sector retail banks? Or do you try and sort of pick out value here?
So, one of the points that you mentioned in terms of rate cuts, I think before the financial year is out, you could see another couple of rate cuts adding up to, maybe 40-50 basis points. That is something which is quite possible because world over the rates are coming down. And so that would be one additional policy action which could be seen in the next couple of quarters. So at this point in time in the market, I think because of the fact that because there is additional volatility, you can't call the bottom. So I think the focus should be on sectors and stocks where there is still steady earnings growth visible of 10-15% or more, even in this environment. And that is where I would feel segments like gas distribution. You have steady earnings growth happening there. That segment has not much to do with the macro slowdown which is presently there, and so that's one segment. Secondly, I think IT services, another segment where you still have a decent demand momentum. Digitization is still resulting in good order visibility. So these two segments, in addition to the banks, because naturally the banks will have to lead the economy and the market out, and banks is another segment where you've had depressed performance over the last 1-2 years. So these are three segments which I would like to focus on. Okay,
Ratnesh, thanks very much. Have a good weekend. Appreciate you joining us here on CNBC-TV18. Well, what's making news in the world of commodities? Remember, our markets may have had 2 trading holidays, but the commodities market has been on. Manisha's here with all the details. Manisha.
Well, in commodities, the best sector really has been the precious metals yet again. We are headed for a third weekly gain for the gold prices. it still is about the concerns in the global economic stand and the geopolitical tensions. And you also have to look at the weak economic data that we've seen come in from much parts of Asia, especially China, Europe, etc., and that continues to be supportive for gold. Even as we did see the prices go below $1,500 per ounce once in this week, there has been an immediate buying there, and we are closing this week with more than 2% of gains coming in for gold. No such luck for the crude oil prices, where we have seen prices continue to slide. Friday, of course, has been a better day, but then you have seen an increase in the U.S. inventories. The U.S. production has been on the higher side. The economic data not so great. But on the other side, what has led to some support has been the oil producers like Saudi Arabia saying that they will, or they are looking to balance the global oil markets, and they are looking to take further steps to ensure that. And that statement perhaps did some good. In the metal prices, while everything else is headed for a negative decline for this week and perhaps in this year as well, where we have copper down 4.5% in this year, zinc is down by 2%, aluminum is just about flat for 2019. It is nickel which is trading at 47% up for 2019. It is also trading at a 5-year highs in the Indian markets, 16-month highs on LME, and that is because Indonesia, the biggest nickel producer, says that they are looking to ban export of ore going forward. And on the other side, you have very strong demand for nickel from stainless steel, from electrical vehicles, etc. So nickel continues to be your price taker in the metal space. Okay. All right, Manisha, thank you very much for that. That's the commodity action for the week. Now, what are the major events one can watch out for in the next week? Well, we have Anisha to run us through that list.
Well, yes, after the busy earnings season that we have had, this week is perhaps going to be a tad bit lighter. However, there are a lot of important global and domestic macro cues to watch out for. For example, we will get the RBI minutes on August 21st. Remember, we had seen a rate cut of around 35 bips. There were some changes to the estimates in terms of inflation as well as the growth outlook for the country in the coming quarters and months. So we'll watch out for what the commentary is like. Apart from that, on August 21st, we'll also get the US FOMC minutes. Now remember, this was the first time in a decade that US Fed decided to cut rates, and there have been recessionary trends with respect to what is happening in terms of the bond yields. So we'll watch out for the comments coming in terms of the global growth outlook there as well. We'll also get the US weekly jobs data on Thursday. We've got most of the earnings, but then there are some late bloomers. So we'll get numbers for the likes of CG Power, Gillette, Everest Canto, Procter & Gamble, as well as Quality in the coming week. Apart from that, there are a lot of important cases to track in the Supreme Court as well as High Court. I've picked up the two. For example, for Andhra Pradesh, there has been this ongoing tussle regarding the renegotiation of PPA. That matter will be brought for hearing as far as the Andhra High Court is concerned. And separately, the Supreme Court will also hear a matter with respect to Mumbai Coastal Road project. So that is something to keep an eye out on. Back to you.
Anisha, thanks very much for that. That's essentially what to watch out for in the coming week. We take a very quick break here. We come back and we'll have some trades for you. Mitesh Thakkar puts out some trades for the week which is coming up. Stay with us.
Welcome back. Here we're taking stock. Time for some technicals, and we have Mitesh Thakkar for that. Now, Mitesh, we had a shortened trading week, but we did manage to end just around the 11,040 mark. What was your takeaway from the week, and what's your dispensation for trade next week?
One, we had a subdued kind of session. The market closed way, or near to the level where we had opened. Not a very decisive session. Also, is the fact that the market, what it's showing in the last few days is resilience at lower levels. We are seeing that because most of the intraday indicators are now pointing up from kind of oversold levels. The selling pressure or declines are not seeing follow through. So on the upside, I think I'm watching this level of 11,065.70 very closely. A couple of intraday moving averages kind of converged there. In case we start getting past those levels, this pullback could extend by about 80 to 100 points, and 11,150, 11,170. With some choppiness and volatility, and maybe failing to get past higher levels, we will see downtrend resume again.
Okay, Mitesh, so in terms of the strong parts in the market and the weakest links, could you describe them for us?
I would say I think the bank nifty or the financials could possibly weaken up. I think we have seen some persistent weakness come into in HDFC Limited and the HDFC Twins. I think the Bajaj Twins also have after a long time they've shown some weakness and the bounce back hasn't been very strong. So I think the leading financial names could come under pressure, and that could see the bank nifty and the other nifty finance index kind of take a hit. So idea is that I think the large cap stocks which have not really corrected, which are kind of slightly on the oversold side, I think these are the pack. This is the pack which could possibly see some decline.
And Mitesh, finally, trading ideas for next week?
I would suggest, looking at a couple of names from a trading point of sight. I think UPL is reversing from extremely oversold levels. I think that can be bought with a stop, let's say around 530 to 533. And this bounce back could see the stock attempt range of around 575 to about 580 on the upside. That about I think Apollo Hospital is something which continues to show strength, made a fresh high today. On mild declines, I think I would still advocate buying this one. I'm looking at trading target of 1500 and then eventually investment or positional targets of around 1550 on the upside. So anything close to about 1440 would be a good buying zone. I think accumulate between 1440, 1430, keep a stop loss below 1400, and 1500 stroke 1550 should be your short term to position targets.
Okay, Mitesh, thank you very much for taking us through those trading ideas. Surbhi, ready for a full working week?
Absolutely. I think back in Bombay for this one. Right now, we're going to take your leave and wish you a good weekend. Back with the markets on Monday.